Welcome to the Deep Dive. We're here to unpack complex topics and give you those essential nuggets of knowledge. Today, we're diving deep into GCT Semiconductor Holding, Inc. That's ticker GCTS on the NYSE. And the big question really is this: is GCT Semiconductor, on the edge of a massive 5G turnaround? Or is it just a value trap heading towards zero? It's a company that really feels like a binary bet.
Absolutely. And our mission today is to try and understand the intrinsic value here. We'll do that by dissecting its operations, the industry it's in, its competition, management, and of course, its financial health. We've got a stack of detailed research, all current as of September 15th, 2025. The share price we're working from is $1.51 SEK from back on September 12th. But look, this isn't just about spreadsheets. It's about the story, the high-stakes narrative behind what is essentially a bet the company's strategic pivot.
All right, a monumental question indeed. Let's start breaking down those fundamentals. We'll begin with part one, the business, management, and financial health of GCTS. So to really get this binary bet, we need to understand what GCTS actually does. Let's jump into chapter one, business analysis. What exactly are they building? Okay, let's unpack this. GCTS operates using a fabless semiconductor model. What does that mean? Well, for anyone unfamiliar, it means they focus entirely on designing, developing, marketing their chips. But they outsource the really expensive part, the manufacturing.
That's right. They don't own the factories, the fabs. This model, it definitely saves them enormous amounts of capital up front. But, and this is crucial for GCTS, it also makes them critically dependent on those third-party foundries. That leaves them pretty exposed to, global supply chain wobbles, potential shortages, and yes, significant geopolitical risks. Think about where these advanced factories are located.
All right, that dependency sounds like a major factor. So given that, how does GCTS actually make money? Are their revenue streams diverse enough to maybe handle some of these pressures?
Well, they have two main streams. First, direct sales of their semiconductor chipsets. Second, licensing their intellectual property, their IP. They use a kind of dual sales channel. They go direct to large clients, but also use distributors for others. And their customer base is pretty spread out geographically: Taiwan, China, Korea, Japan, Europe, North America. So yes, some diversity there in customers and regions.
Okay, so let's dive into the products themselves. What's the key thing we need to grasp here? What's the big bet they're making?
So GCTS focuses on system-on-chip, or SoC solutions. These are for wireless communication. Think of them as highly integrated chips packing multiple functions, RF transceivers, modems, all onto one piece of silicon. Historically, they had legacy 4G LTE solutions. Those went into mobile hotspots, routers, machine-to-machine stuff. But the absolute core of their strategy now is their pivotal 5G NR solutions. This is key. They are deliberately winding down the 4G business to go all in on 5G. Right now, they're in that really crucial customer sampling phase. They're getting initial samples out to lead customers like Orbic North America and Airspan Networks. And this huge high-stakes shift, well, it directly explains those dramatic drops in revenue we've seen recently. Beyond just the main 5G push, they also do chipsets for IoT, or what's called non-terrestrial network, or NTN connectivity. That's mainly for low-power IoT. And there's a notable partnership with Iridium Communications for satellite-based NTN service. That helps them reach areas traditional cell service can't.
Okay, and where do they sit in the market? Scale-wise, GCTS is a microcap, right?
Yeah.
$84.35 million market cap. They're definitely a niche player. They're not trying to go head-to-head with giants like Qualcomm or MediaTek on price or volume in, say, the smartphone market.
Exactly. Their strategy seems pretty clear. Target the underserved segments. Think fixed wireless access FWA that's using 5G for broadband where wires aren't practical. Also, private 5G networks, industrial IoT, and those satellite-connected devices we mentioned. Success for them isn't about grabbing huge market share globally. It's about becoming an essential sort of embedded partner in these specific niches. And that puts them more directly up against companies like Sequans and Nordic Semiconductor.
Yeah. So their main pitch, their value proposition, is essentially being a reliable and innovative alternative source for 5G chipsets. That probably appeals to device makers, OEMs, worried about having all their eggs in one basket with the big suppliers, right? And GCTS offers these complete integrated SoC platforms. The idea is to make life easier for customers, speed up their development time. But how big is this playing field they're on? What are the wider industry forces? Let's shift to the industry analysis.
Well, the overall semiconductor industry outlook for 2025 is frankly exceptionally strong. We're talking projections exceeding $700 billion. The big driver now, interestingly, is AI. It's actually overtaken automotive, and wireless comms is the #1 driver for the first time. 5G is right behind it. And then you've got IoT and automotive still contributing significantly. Now, for GCTS, this broad market growth is definitely a tailwind. They're a small boat, currently struggling, but in a rapidly rising tide. I mean, even grabbing a tiny, tiny fraction of the overall 5G market would mean exponential growth from their current revenue, which is just, what, $6.07 million trailing 12 months. But, and it's a big but, the competition is fierce. You've got the giants, Qualcomm, MediaTek, Broadcom, with massive resources. Plus, there's this trend of vertical integration. Big tech companies like Apple, Google, even Tesla, designing their own custom chips.
You mentioned the CHIPS Act earlier. That's supposed to boost U.S. semiconductor production, maybe offer some R&D benefits. But for a fabless company like GCTS designing in the U.S., manufacturing overseas, do those benefits really help them much? Does it offset their unique challenges, or is it more for the companies with U.S. factories?
Yeah, that's a really good question, and it's complicated. Being fabless, GCTS likely won't see the same direct manufacturing benefits from the CHIPS as companies actually building or running fabs in the U.S. And this brings us to a really critical, potentially existential threat that proposed a 100% U.S. tariff on imported semiconductors. It's being discussed by the current administration. For a fabless company like GCTS, this is huge. Designing here, making chips overseas, a tariff like that could effectively double their cost of goods sold overnight. It could make their products completely uncompetitive, potentially fatal for their whole business model. It's a major, major risk factor.
Wow. Okay, so that tariff is a huge shadow hanging over them.
Yeah.
So if we talk competitive advantages, they don't have brand recognition outside their niche, and definitely no cost advantages due to scale. What do they have?
Right. Their real edge, potentially, lies in switching costs for customers. Once a company designs a GCTS chip into their product, well, switching to a competitor isn't easy. It's complex, it's expensive, it takes time. These design wins, as they're called, can create sticky relationships. That's one thing. The other, and arguably more vital for their future, is their proprietary intellectual property in the new 5G sauce. That, backed by what seems to be a very experienced engineering team, is their key unique asset.
Okay, that sticky relationship makes sense once they're in. But what about getting that initial design win, especially against the huge players like Qualcomm? Is that switching cost argument enough to overcome the scale and pricing power of the giants?
Oh, it's definitely a massive challenge, no question. They aren't going head-to-head in the massive volume markets. Instead, they're sort of banking on the fact that larger OEMs often want supply chain diversity to reduce their own risk. Being that reliable, innovative alternative source is their angle. They're hoping their integrated SoC platform offers enough value, enough ease of development in those niche markets they're targeting, that the design-in process, while still tough, becomes worth it for the customer.
Okay, let's shift from the market position to the people running the show. Time for Chapter 2, Management Evaluation. Who's at the helm? We've got John Schlafer as CEO. He's been with GCT since 2003, CEO since 2013. That's a long tenure, an industry veteran. He's navigating this huge tech pivot in what looks like a severe financial crisis. What is that long time in charge, especially through tough times? Tell us about his leadership. Can he keep people confident?
Well, his track record, it really shows a laser focus on just survival, frankly. He's been key in securing financing, even when it meant dilutive equity offerings or taking on debt, like that recent $10.7 million term loan from their largest shareholder, Anapass. That alone shows an ability to keep strategic stakeholders believing, right? To keep the lights on. It suggests, a deep conviction in the company's long-term plan, despite the current pain. And importantly, management seems pretty transparent. They put out press releases, they show up at investor conferences. Crucially, they explicitly state in their filings that there's substantial doubt about the company's ability to continue as a going concern. Now, that sounds alarming, and it is, but that level of honesty actually builds some credibility. It frames the current struggles. And our research didn't turn up any reported ethical issues.
Okay, and capital allocation. It sounds like it's all hands on deck for 5G. R&D spending jumped 62% in 2024 to $17.3 million. That's a lot for a company this size. All capital raised is going straight into 5G development and getting ready for mass production, right?
Exactly. But the impact on shareholders has been pretty harsh. No dividends, naturally, you wouldn't expect any. More critically, there's been significant shareholder dilution. The number of shares outstanding went up by over 63% in the last year alone. And, let's be honest, more dilution seems highly likely as they keep needing cash to fund operations. Now, look at their return on invested capital, the ROIC. It's a deeply negative 60.26%. Compare that to their estimated weighted average cost of capital, or WACC, of 9.25%. When you see an ROIC that negative compared to the cost of capital, well, it means every dollar they're investing right now is effectively destroying value at an alarming rate. This just underscores the absolute pressure. Those 5G investments have to become incredibly profitable, incredibly quickly, otherwise they just can't sustain this. The entire investment case hinges on a future turnaround where that ROIC flips positive and actually exceeds their cost of capital.
Wow, minus 60% ROIC, that really puts the pressure in perspective. These ambitious plans, the experienced leadership, it all clashes starkly with the current financial picture. Let's dive into Chapter 3, financial analysis. The numbers tell a story. Okay, key metrics review. Market cap, $84.35 million, firmly microcap territory. That means higher volatility, higher risk baked in. Revenue growth trends, well, more like revenue decline trends over the last 5 years. A steep drop from $25.5 million in 2021 down to just $6.07 million trailing 12 months. That's a 54.7% decrease year over year. You called it the J curve of their 5G transition, that deep planned dip, hoping for a sharp rise later.
Exactly. And the profit margins just hammer home the severe financial pressure. Gross margin is okay, 43.9%, not terrible in itself. But the operating margin is a deeply negative moated 5,258.2%. And net profit margin, an astonishing moated 536.8%. I mean, those numbers are just staggering. A net profit margin of over negative 500%. It's not just a sign of trouble, it's the stark financial reality of a company tearing itself down to rebuild. Every single dollar spent on 5G R&D absolutely must deliver massive returns down the line just to climb out of this hole. It's not about small improvements, it's about a complete financial transformation. So these historical figures, they really just show the current severity, not future potential.
Those figures are, it's staggering is the word, makes you almost wince looking at them. Is this level of cash burn and negative margin, is it somewhat typical for a company doing such a drastic pivot? Or is GCTS really operating right on the absolute financial edge?
Look, it's certainly extreme, even for a company in transition. The sheer scale of the losses, especially relative to their tiny current revenue, it really highlights how incredibly thin their margin for error is. They are walking an exceptionally tightrope. Any significant misstep, any delay in the 5G rollout, it could be catastrophic for them.
And free cash flow, burning cash fast. You said negative $24.1 million over the last 12 months. That gives them less than a year of cash runway at this rate. So they constantly need external funding just to keep going.
That's the reality. Earnings consistency, well, consistently negative recently. Trailing 12-month earnings per share, EPS, is negative $0.68. The balance sheet is severely distressed. We're talking negative equity of negative $70 million. That's accounting insolvency. Total debt stands at $52.41 million. And their current ratio, alarmingly low at 0.21. That means they have only 21 cents in liquid assets for every dollar of short-term liabilities coming due. This isn't just a red flag. It's a quantitative scream justifying that going concern warning. They are quite literally running on fumes. And dividends, obviously none. Not relevant here.
Okay, let's talk valuation. Price to earnings, PE, is negative, so useless. But price to sales, PS, is 13.7x. You said that's nearly 4 times the peer average of 3.5x.
Yes, and what's really striking here is why. This premium PS multiple, despite falling revenue and massive losses, strongly suggests the market is already pricing in a dramatic, successful 5G turnaround. It's valuing future hope, not current reality. Now, for intrinsic value, we often look at a discounted cash flow or DCF model. Briefly, that involves projecting future cash flows, discounting them back to today's value based on risk, and summing them up.
Right, and given how uncertain GCTS's future is, a single DCF number doesn't make much sense.
Yeah.
You mentioned a range based on different scenarios.
Exactly. It's highly binary. Our educational DCF model came up with this range. Bear case, the 5G launch fails. Value is effectively 0. Bankruptcy. Base case. Moderate 5G success. Maybe $2 to $2.50 per share. This assumes a sharp revenue jump starting in 2026 or 2027. Bull case, strong 5G adoption. Could be $4.25 to $5 per share. This needs exponential growth and rapid margin improvement. But, and this is critical, the assumptions behind this are highly speculative. We assumed continued revenue decline in 2025 and explosive growth like 1,600% in 2026, tapering off later. We used a very high discount rate of 22% to reflect that extreme risk and the substantial doubt warning. And we assumed operating margins eventually turn positive and reach 15-20% long-term. Huge assumptions.
Okay, that's a comprehensive look at the business, the management, and the stark financials. Let's broaden our view now. How does the market see this company? Who owns it? And what are the big risks? This brings us to part 2, market, ownership, risk, and conclusion. We'll kick off part 2 with chapter 4, market sentiment. What the street thinks. Market perception. Well, it seems GCTS is only covered by one analyst. That analyst has a strong buy rating and a very bullish 12-month price target, $4.55. That's implying what, 198% to 231% upside from where the stock is now.
Yeah, and that immediately raises a question, right? A consensus based on just one opinion, especially a very bullish one, is pretty fragile. It makes the whole investment thesis very dependent on that single forecast being right. It hasn't really been tested by multiple viewpoints. Interestingly, though, the market has reacted positively to recent operational news. Things like the 5G sampling success, that Iridium partnership, the financing from Anapass, that news seems to drive sentiment, often overshadowing the grim financial reports. Looking at market indicators, short interest is notable. It's between, say, 4.9% and 6% of the float, but the days to cover ratio is high, around 12.1 days. That suggests potential for a short squeeze if good news hits and shorts rush to cover their positions. Price versus moving averages. Well, it's trading above its 50-day moving average, up $1.51 versus $1.38, which suggests some short-term positive momentum, but it's still below its 200-day moving average, $1.51 versus $1.74, indicating the longer-term downtrend is still technically in place.
So the market signals are definitely mixed. You've got skepticism shown by the short interest, but also this potential for a wild ride upwards on any positive catalyst. It really just highlights how speculative this whole thing is, doesn't it?
Absolutely. It's a classic case of the market wrestling with deep current problems versus potentially significant future gains. Very polarized.
Okay, market perception is one piece, but knowing who actually holds the stock can tell us a lot about conviction. Let's move to Chapter 5. Ownership structure. Who's betting on GCTS? Started with stakeholders, institutional ownership seems relatively low, around 8% to 13%, but the largest holder is Anapass, Inc., with 14.35%. And Anapass isn't just a passive investor. They're a strategic partner and a key creditor. They provided that $10.7 million loan. That dual role feels like a pretty strong vote of confidence, wouldn't you say?
It definitely does. It signals they have skin in the game beyond just equity ownership. Then look at insider holdings. They're substantial, over 20%. And if you connect the dots, one director, Han Sushin, has been consistently buying GCTS stock. We're talking significant amounts, hundreds of thousands of dollars worth, right through May to September 2025. This persistent insider buying, especially by a director, is a powerful bullish signal. It directly contradicts the awful financial statements and suggests strong internal belief that things will turn around. Ownership is quite concentrated overall. Anapass and another entity, SUMP Corporation, together hold over 21%. That concentration can offer stability, but it also carries risk if one large holder decides to sell down their stake.
Okay, strong insider buying is definitely noteworthy, but every investment, especially one this polarized, comes with big risks. Let's tackle Chapter 6, risk assessment. The hurdles ahead. Maybe a quick SWOT analysis helps frame this. Strengths. They have proprietary 5G tech, experienced leadership, existing ecosystem relationships. Weaknesses, extreme financial distress. That going concern risk is huge. They lack scale. Customer concentration is also a worry. Opportunities, massive 5G market growth, potential leadership in niches like FWA or private 5G, and the chance for a big valuation re-rating if things go well. Threats, intense competition, huge execution risk. They need a flawless 5G ramp-up, and just general semiconductor industry cyclicality.
And beyond those company-specific factors, you have macroeconomic pressures, high interest rates. That's a serious start for a company like GCTS that absolutely relies on external capital. Makes borrowing more expensive, harder to get. Plus, a broader economic slowdown could easily dampen demand for their end products, delaying that crucial 5G revenue ramp they desperately need.
We mentioned the GCTS Act earlier as a minor positive, but you also flagged a geopolitical risk that sounds much more significant, potentially game-changing even. Can you remind us about that potential 100% U.S. tariff threat and why it's such a big deal for GCTS specifically?
Yes, this is absolutely critical. It's potentially an existential threat because GCTS is fabless, relying on overseas foundries. A 100% tariff on imported semiconductors would effectively double their cost of goods sold. It would likely make their products completely uncompetitive, at least in the U.S. market, and could quite possibly be fatal to their entire business model. This single geopolitical risk factor has the potential to completely override everything else, their tech, their execution, their market opportunity if it comes to pass. It's that serious.
Wow. Okay, so we've covered a massive amount of ground, from their cutting-edge 5G pivot right down to the precarious financial tightrope they're walking and these huge external risks. Let's try and pull it all together in Chapter 7, the conclusion. A binary bet. Okay, the bull case. What's the argument for GCTS? Well, they're positioned in a massive growing 5G market. They seem to be hitting key technical milestones, like getting those 5G samples out. You've got strong insider conviction shown by that consistent buying. You have strategic backing from a major shareholder and creditor, Anapass. And you have that one, albeit lonely, bullish analyst projecting massive upside.
Right. But the bear case is equally, maybe even more compelling right now. The company faces extreme insolvency risk. That going concern warning isn't just boilerplate. They have unsustainable cash burn, intense competition from players with vastly deeper pockets, and then there's that looming existential threat of a 100% U.S. semiconductor tariff. Plus, further shareholder dilution seems almost inevitable. So, summarizing the valuation again, it's highly speculative, truly binary. Our educational DCF model gave that wide range. $0 for failure, maybe $2, $2.50 for moderate success, possibly $4.25, $5 if everything goes perfectly right.
So GCT Semiconductor really is a classic binary investment. That current $1.51 share price seems to reflect both the deep financial distress and some non-zero chance of a successful 5G turnaround. The investment truly boils down to whether management can flawlessly execute this incredibly difficult 5G roadmap before the money runs out. It's a total story stock right now. Future potential is battling grim current reality. The outcome, highly uncertain.
Yeah, this deep dive really throws that tension into sharp relief, doesn't it? The tension between a company's grand vision and its immediate, harsh financial reality. It really makes you wonder, how much future potential can the market realistically price in before that present financial strain just becomes too much to ignore? If you were following GCTS closely, what single key indicator would you be watching most intently right now? Something to think about.
Absolutely. Well, that was our deep dive into GCT Semiconductor. If you found this insightful, if you want more analyses like this, please do like and subscribe to the Stock Analytics AI YouTube channel. And remember, Stock Analytics AI members is just $4.99 a month. Get priority deep dives on tickers. We are covering all of the S&P 500 stocks over the next few months, and members get that exclusive priority access. If you just want a one-off deep dive on a specific stock you're interested in, drop us a super thanks. We appreciate the support.
And just the usual reminder, this analysis was generated by an AI system. It's purely for educational purposes and definitely should not be taken as financial advice. Always, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.